So in this class, we are going to solve 3 questions on international investment appraisal. SAPA PLC expects to generate pre-tax net operating cash flows for 3 years from its US subsidiary as follows. Year 1, it has $100 million. Year 2, it has $120 million. And year 3, it has $130 million. The corporation tax rate in US is 25% and 30% in the UK. There is a double taxation treaty in place in the 2 countries, and all tax is paid in the year after the liability arises. That means in arrears, right? The current dollar to pound spot rate is $2 to £1, and the US dollar is expected to weaken by 10% per annum against sterling. SAPA PLC uses a sterling cost of capital of 10% for all projects. Required: calculate the present value of each cash flows from the US subsidiary. This is a very simple question. Based on my explanation in the last class, I think you should be able to sleep and solve this one in your sleep. As you can see, they're asking you to calculate the present value of the cash flows. Just like our normal present value, you discount. The only difference here is because, there is conversion. So you have year 1, you have year 2, you have year 3, right? They didn't even give you all those initial investment. They didn't give you sales. They already gave you directly the pre-tax net operating cash flows. They gave it to you here as what? $100 million, $120 million, and $130 million. Pre-tax cash flows. The next thing for you to do is to tax. Now you tax at what? At how many percent? This is a US currency, and the US tax rate is what? US is 25%. Can you see that? You tax at 25%, but UK is 30%. So this means that there's an extra 5% that they should go and tax in the home currency, right? In the home country, in UK. Does that make sense? So you tax at 25%. So because it is 1 year in arrears, it will extend to what? Year 4. So in year 1, 25% of 100, that's 0.25 times 100. You have 25. It will be applicable in year 2. So you put it in year 2, $25 million, right? Year 2 tax, 0.25 times 120. You have 30 million applicable in year 3. 0.25 times 130. That's 32.5 million. Should I use 33? They say we should round up. They didn't say we should round up. So let's just put it there as 32.5 million, right? So you, after that, you get your what? Post-tax cash flows. It means they are done with business now. Once they have post-tax cash flows, they are done with business, right? So here you have your 100 million. Here you have 95 million. You have 100 million. And here you have your 32.5 million negative. Does it make sense? So it means that this is the post-tax cash flows that you would take to. So it means this is the post-tax cash flows that you would take to the main country, that is the home currency. You know, because the main company is SAPA Limited. It means that that's main company of concern. Their home currency is pounds, right? So this is post-tax cash flow to where? UK, right? Now when you get to UK will not receive this money as $100 million. They need to receive it in their own currency. That is where conversion comes in. So you quickly go to your workings note, you flip your page. I'll clean this one off, the one that has workings. So workings in year 1, year 2, year 3, year 4, because you need to know your what? Interest rate. Now what is your exchange rate today? They said that the current dollar to pound rate is what? 2. That is $2 equals £1. Of course, dollar is weaker than pounds because you have to give more dollars to get £1. This thing means two. I'm not even explaining. We explained it in the previous class. If you have not watched previous class, go and watch it. So to get my currency in year 1, how are you going to get? I said they can give you through interest rate parity or purchasing power parity, right? But here they didn't give you all of that. They told you that this is how it's going to be. The US dollar is expected to weaken by 10% per annum, meaning that you are going to give more of the US dollar to get just 1 UK pound, right? So in year 1, it's going to be what? $2 multiplied by 1.1, $2.2, right? To £1. You can see it's weaker because you are now giving more. By year 2, it's going to be that year 1 will now be the spot at that time, right? It will be what? $2.2 multiplied by 1.1. Just say it's already in your calculator, times 1.1. That will give you what? 2.42 to £1, right? By year 3 it will be what? 2.42 multiplied by 1.1, so times 1.1, and that will give you 2.66, right? 2.66 to £1. Then by year 4 it will be 2. Do we even need year 4? Okay, 2.66 multiplied by 1.1, that's times 1.1, and that will give you 2.93. I don't think we need this one. 2.93 to £1. You now say what? Cash flows to UK. You just close this one. Close it. It means SACPA PLC will receive their cash in what? In year 1, they will receive their cash as look at conversion now. Me, because I know it, I just know I'll say 100 million divided by 2.2. Because if somebody in UK wants to receive $100 million, right, is what? He wants to receive $100 million. In how much? In how much pounds? You don't know. X, right? But it's the exchange rate that will help you. And the exchange rate is what? In year 1 is what? $2.2 that will give you this. So you cross multiply, you have this times this. That will be 100 million times 1 over 2.2, right? X will now be the subject of formula. Do you understand? That's why it is 100 million divided by. And I said it in the previous class that when you are converting to base currency, you divide. You know, we are taking cash flows to UK, which is in pounds, right? So you are going to divide. I hope I'm not over explaining, because in my previous classes, like when I just started this SFM, some people have said that, please explain like somebody has zero knowledge on it. So in case you are watching and you already know these things, please just be patient, because we are doing it like somebody does not even know it at all. Do you understand? So what I explained in the previous class was that if you are converting to base currency, which I advise you to watch that previous class, you always divide. Okay, so because we are converting to UK and this is the base currency, the one that carries 1, this is counter currency, you divide. So you say 100 million divided by 2.2. So they are receiving 45.45. Let me just put it in 1 decimal, please. Right? So they are receiving 45.5 million pounds. We have converted. Can you see that? For year 2, you need to divide 95 million divided by 2.42. That's the exchange rate. 2.42. You have 39.3, right? 39.3 million pounds. Okay. Now 100 million divided by 2.66. You have 37.6 million pounds. So in year 4, you have, that one is a negative, but you still do it, right? 32.5 divided by your exchange rate in year 4, 2.93. That will give you 11.1 million pounds. It makes sense. Now, where's my duster? So when these people receive this cash to the UK, you think they'll just be cashing out? No, they still have extra 5% tax to pay. Why? You must have checked the tax. So remember the taxation issue in investment appraisal that I explained, that when the home country has more tax, the tax rate is higher, they will pay the additional. So there will definitely be an additional tax, right? Additional tax of how much? 5%. Now this 5%, where will they apply it on? They won't apply it on this, so it will only reduce this amount, the amount that has gotten to them. The additional tax will be on the tax base. There's a tax base, and is what? This one, pre-tax. You can't be taxing an after-tax balance. It's a pre-tax balance you tax. This is the tax base, right? So now, as I said, you should not clean your exchange rate because you still need your exchange rate, right? So you need to get that tax in pounds, because you don't want, you can't be minusing. If you put 5% of $100 million, you get your answer in dollars. You can't minus dollars from pounds, right? So how do you now get for year 1, which of course is what? 5%, right? So that's 5% of 100 million, but you will convert divided by your exchange rate in year 1, which happens to be $2.2, right? 5% multiplied by 120 million, right, divided by 2.42, and your year 3, 5% multiplied by 130 million divided by $2.66. so you must convert. Okay, so what you did is just that you picked the remaining 5% balance. We are just converting it. That's just it. So it's something you show in your working notes also. You have 2.3 million pounds, you have 2.5 million pounds, you have 2.4 million pounds, right? So this is your tax in year 1, year 2, and year 3. So you deduct it, the additional tax. Now you're going to deduct it in year 2, year 3, and year 4 because of the 1 year in arrears tax. Okay, so you have 2.3 million here, you have 2.5 million here, and here you have 2.4 million. Does it make sense? So let's clean up this one. So you now have your net cash flows. It's now that one you will now discount. When you discount it, you now have your present values. They didn't say you should calculate the net present value, so you don't need to cast that, right? So you have your net cash flows. Net cash flows after additional tax, if you like, write that story. Here you have your what? 45.5 million. Here you have, that's 39.3 minus 2.3. You have 37 million. You have 37.6 minus 2.5. You have 35.1 million. You have 11.1 divided 11 point. Here you have minus 11.1 minus 2.4. You have minus 13. You have minus 13.5 million pounds, right? So this is our net cash flows in the UK in SAPA PLC, what we actually care about. Okay, then next thing is to discount. Whenever you're asked to get present values, they're asking you to discount. Discount at what rate? Where's our question? They said SAPA PLC uses a sterling cost of capital of 10% for all projects. So you discount at 10%, right? So year one, 10% is what? 0.909, 0.826, 0.751, 0.683. Please, this is because I've used 10% over time. That's why. Not like I'm saying it from my head, right? So I know how to get this discount factor now. 1 plus r raised power minus n. So 1 plus 0.1, 10%, raised power minus 1, raised power minus 2, raised power minus 3, and raised power minus 4. That's how you get all of this. So now let's discount. When you multiply, you get the present values. So if you multiply this by this, you get your present values, right? And that's the end of the question. That's what they ask you to solve. Let's go to the next question. Okay, so the next question, as you can see on the screen, is Passati. Passati Co is a UK-based company,